Hannah wants to make special mention. So Startup Stack, great supporter, all things SaaS for your startup. Kiln is where the Midday Connect and some of Venture Studio work from. They're wonderful partners, and if you need space for a day or a week, hit them up or contact us.
Spencer, before we jump in there, do you mind if we give Sarah 45 seconds?
Oh, I'd love to give Sarah 45 seconds. Sarah, take up to a minute if you need it.
Thanks, guys. Hi, everyone. I don't know if I've met everyone here, probably not, because there's lots of wonderful new faces every week, but I'm the director of new ventures here at Summit. And I just wanted to take a quick second to ask or see if anyone here has the interest or referrals for a job that we are listing here at Summit Venture Studio. We are looking for a president to run a med tech company. I'm going to go ahead and post the job link in the chat as well as my email. Please feel free to have them apply through the job link or send me an email if they're interested with their resume. And I'm really looking forward to hearing from everybody on that. So thank you for my 45 seconds.
Thanks,
Sarah, just so you can know, you can basically reverse look up someone in Sales Navigator, just like you were doing lead gen, and find everybody that has that background and send them a message saying, do you know someone or yourself that's interested? So there's a way to kind of source really good people that already have a job into that position.
Sarah, Sarah, are you working with agencies at all?
No, not at the moment. We're currently just working with our network, but I'd love to connect with both of you to talk a little bit more about that, because I'm definitely new in the recruiting space. So any advice or tips?
I'm sending you a connection request right now. I am wanting to get back into the executive level recruiting and being able to have a role like this that I pitch, even if we set up like a 0.5% or 1% fee or something. Getting that one role will help me get into the game more. So maybe we could work something out that works out for both of us.
That would be awesome. Looking forward to chatting. Thank you.
Yeah.
Thanks all. Power of the crowd. Great. Rob, let's do it.
Cool. Cool. And Sarah, that actually sounds super interesting. I might have a few people as well. So I'm just going to go ahead and save that link to forward around. And if anyone's relevant, I'll connect you. But cool. Hi, everybody. I'm Robert. I'm the co-founder of a company called Deco, as well as an active VC myself. We'll dive a little bit more into my bio in just a bit, but I'm excited to share a little bit today on the different investors that you'll meet throughout your fundraising journey, along with how to tailor your pitch deck and your investor materials in general to them. So just before I get started on the presentation and everything on that side, maybe I know there's some kind of hand raising function or something here, but just in a quick show of hands in some way, shape, or form, how many people here are startups that are going out to potentially raise money or work with startups that are potentially raising money? Awesome. Okay, so we got quite a few people here. That's awesome news. Oh, cool. And some of you guys figured out how the hand raising feature works. I will ask you about how to do that later. In the meantime, why don't I share my screen? But it sounds like we got an awesome audience of people here, all founders kind of going out to raise or working with founders on that side. So why don't I go ahead and share this? Right now, you will see my generic computer background, but in just a sec. So can everybody see this? Awesome. All right, cool. So as mentioned before, this is going to be a short presentation about the different investors you'll meet, along with how to tailor your pitch deck for each and every single one of them. As you're going out to raise money, you will interact with these types of investors. And each one of these investors will make decisions differently. And because of that, your investor materials are going to have to stand out in different ways. So in terms of what we'll cover today, we'll do a quick intro on myself, then we'll go into the categories of investors. And then from there, we'll dive right into Q&A, and we'll leave most of it for Q&A. So quick on me, I'm Rob, anything but Bobby. I'm the co-founder and partner here at Deco. Additionally, I'm an active VC. I'm number 2 at a firm called Evolution VC Partners, where we're early investors in about 280 pre-seed through Series E culture tech companies. So technology product services that you interact with every day. So think companies like Sweetgreen, Beyond Meat, Via, Masterclass, Carta, you name it. The kind of things that founders or just individuals are interacting with on a daily basis and are impactful to our culture, we're involved in. Additionally, I'm the founder and GP of a firm called Timeless Ventures, which invests into revenue generating impact focused businesses. And across our entire portfolio, the one thing that all these companies have in common is that they're all raising money. And because of that, I started off as helping our portfolio companies raise money by creating their investor materials. I've had a weird passion for making pitch decks since I was in high school. I always say that I feel terrible for my girlfriend because I bring her in to show her slides that I made. I'm like, look at this slide. And she's like, wow, great job. But, I've had a weird passion for making pitch decks for years and started to use it as a way to help portfolio companies raise money, as a way to be a more helpful VC than others would be, and ultimately build goodwill with founders so that when they were going out to raise money, they would still consider us for those raises. And it worked. I've gotten into oversubscribed rounds because they said we could not have done this had we not had your pitch deck. So on that side of it, it was starting to work for me. About 3 years ago, we started Deco, which is now the leading pitch deck development company for startups and venture capital firms. We've worked with over 180 different startups and venture capital firms. We cover 25 plus different industries and additionally even more stages and across a wide variety of stages.
Is Miss Amber in?
Oh, and we do that through and we do that through our network of what we call principals and designers. The way we built what we built is I started off just doing this on the side for founders after work. Ultimately, it started to really balloon out of control in a very good way. Accelerator programs are reaching out to us, venture capital firms are reaching out to us, investment banks, members of British royalty, you name it. We're reaching out. You'd be shocked who needs decks. And started reaching out saying, could you make pitch decks for us? Could you make pitch decks for our portfolio companies? So we had to decide, well, how do we scale this? We didn't want to go the route of every other agency, which is, double my prices, get half the clients, etc., till I have, a ton of vacation time and I could charge $50,000 to $100,000 for a deck. That felt way too expensive for most founders who are going out to raise their first, second, or third round of funding. On the other side of it, I'm sure you've all seen the templates on all the online websites. You could Google pitch deck template, and there's no shortage of them. The 12-slide template. No one's ever hired us to fill that in. The reason they hired us was because I am an active VC and I know what I want to see across my own desk. And so because of that, we came up with a new way to do this, which is we went to other VC funds and we said, do you guys want to make pitch decks for startups? Do you guys want to work on this? And the response was overwhelming. It had been an excellent way for me to meet founders, and now it became an excellent way for over 35 other active VCs from other funds and designers to meet founders. And what we do is we connect each founder with a curated deal team of an active VC with experience investing in or building decks in their space. So think if you're an AI company or you're a Web3 company or you're a marketplace or you're a SaaS product or you name it, we have a principal that can work with you on it. There's all sorts of funny stories about the kinds of decks we've released in the same week. One's for network simulation companies, which are incredibly technically involved, and then other ones for companies that help you find hot dog stands near you. So the very wide range of companies that we've been able to work with because of this model. And then, of course, our designers who then design the decks completely from scratch. So our VCs create the content and our designers design it from scratch so that you as a founder get a pitch deck built from scratch by the kind of people who would actually be reviewing it and then designed by experts. All that to say, today we're going to be talking about the different kinds of investors that you'll meet throughout your fundraising journey. There's hundreds of different variations of each one of these four, but these are probably the four most likely that you'll meet, and each one of them has different decision-making processes. So the first is angel investors. Angel investors are individuals with capital to invest. There's basically any accredited investor in the United States can be an angel investor, though only about 2% of qualified angel investors qualified investors or accredited investors have actually made an angel investment. So chances are you could be an angel investor's first angel investment. And we'll talk about that in a second. The next is venture capital firms. These are professional firms. These are the firms that you hear about every single day that exist to invest in startups. They've raised money. They have their own economics, which we're going to talk about because that's going to define how you pitch them and how they're viewing your company. And they invest larger amounts of capital. The next is strategic or corporate investors. These are other companies, established businesses that you've heard of that invest either off the balance sheet of their own companies or create separate funds to invest into startups to accelerate their own business objectives. I ran a corporate VC for some time for a publicly traded technology company. So I'm very familiar on that side about what that does for organizations, and we'll talk about that as well. And then the last is accelerator programs. Accelerator programs, many of you have probably heard of them already, but are structured curriculums and programs that startups go into to grow their business quickly, typically funded by sponsors or by another fund. And they'll take you through a program which ultimately culminates in what they call demo day, which we'll talk about at the very end. So with that, let's dive right in. The first is angel investors. Angel investors are individuals with capital to invest out of their own pockets. These are people that you see every single day on the street. They are VPs at other companies. They are founders themselves. They're people who are just independently wealthy in whatever way, shape, or form that they are. The way that they make investment decisions is very different than other people in terms of how they make investment decisions, in the sense that they develop extremely personal relationships with the companies that they invest in. What that means is rather than just looking at your unit economics or your likelihood of an exit, things like that, they are much more attracted to your vision, the problem that you're solving. Is this something that they've personally experienced? Your product, your team. If they can build a personal relationship with the company that they're investing in, they are significantly more likely to invest. And on the same note, because of that, they're incredibly social in terms of how they invest. Angel investors often work together in what we call angel groups. So big collections of angel investors, anywhere from 20 to 2,000, even more in some cases, where they share deals with each other, diligence deals together, get each other's opinions on them. Each one will have their own perspective and experience that they'll use to make an investment decision. Someone might come from your industry, so they'll be highly technical. Someone might be a former founder themselves, and so they may be much more interested in how the founder makes decisions. Each one of them will work together to make individual investment decisions, but they will share deals around with each other. And so the way that you tailor your pitch deck to an investor like that is you make it very easy for them to be conversational about your business. And the way to do that is in a couple ways. One, use plenty of product images. Product images will speak volumes about your product, and it will go the furthest in terms of putting this in an investor's hand. The more they can visualize the product, the more they can visualize your offering. And if you don't have a physical product, you could do things like case studies with customers. You can do things like demos. You could do things like testimonials. Anything that you can show to make this feel very real to them is going to be incredibly important, because they're going to go out, invest into your company, and then talk about it with 20, 30, 40, 50 other people down the line as they go through their own lives. So with angel investors, the most important thing to do is allow them to be conversational about your business. And then from there, help establish as much of an emotional connection with the business as you possibly can, so they could feel personally invested because they are personally investing into your business. The next is venture capital firms or institutional investors. These are professional funds that are dedicated and exist to invest into startups. The first thing we need to know about these firms is how they make money. They make money on what's called the 2 and 20 model. Many of you are probably familiar with this, but the way that it works is fairly simple. If you were raising, let's say, an $100 million venture fund, the fund managers receive $2 million a year to grow the fund. That's awesome. They use that to buy their offices, to pay their analysts, to pay themselves, etc. But where they really make money is on the 20% carried interest. let's say that $100 million turns into a $1.1 billion total return. So they have $1 billion in profit. They will take home $200 million. So that is much more what they are after than just the $2 million a year in management fees that they may be getting. Now, that said, it is very hard to return a venture fund. 9 out of 10 companies that they're investing in will fail. And in venture capital, in startups, since these are private companies, that is binary. It's not like they're selling their shares at a 30% discount, or they're selling their shares when the market's not doing well. Their shares will go to zero. So if they put 10 million bucks into a company, it's gone. And so the other investments they make will have to not only make money themselves, but make enough money to return the zeros that they had in their portfolio. And so you have to make a case in that scenario about why your company is able to deliver that large of an outsized return. In almost every case, they're banking on just a small handful of their companies to return the fund. They also invest on what's called a mandate. So they have a specific set of rules around what they can invest in, either industry, stage, the amount of time that they can spend deploying the actual fund itself. And they can't really vary from their mandate. They raise money on this mandate, and their investors understand that this is what they're investing in. This is why they invested in the fund. And so it's important to know what the fund's mandate is, what their thesis is, what kinds of companies they invest in, because that will help define whether or not you should even be pitching them in the first place. And then the last thing is the way they make investment decisions is more analytical. They conduct more due diligence on their company. So they'll do a lot more research, dive into your financials, your product, your intellectual property. They'll even talk to customers. They'll do that work. And all of that will culminate into an investment memo and a committee meeting to make a final decision, an investment committee meeting. Your investment memo, this is where your deck really comes into play. The person who's championing your deal inside of the venture capital fund will use your deck to create their investment memo. That means that they will use your deck and your narrative and your story as a jumping off point for their own due diligence, for their own case that they're making to their managing partners. They will use your deck as their jumping on. And so when you're creating your deck for them, provide detail, provide the product images and everything else that we described, but help them fill out that memo. Give them more detail on your unit economics, how you attract customers, why you're competitive, why you have a competitive advantage, why it is that you're fundamentally different in the market than the competitors that they will find online. Another helpful thing to do here is link to primary sources. Give them the studies that you're reviewing to help them understand the way that you come at either your market size or your competitive positioning or your intellectual property. Help them understand those things and give them all the resources, because they're going to do research on your company anyways. So it's best to own that narrative as much as you possibly can. Again, they will be conversational about your business as well. That investment committee meeting will not involve you as the founder. So your deck will have to talk when you're not in the room. And so this is an opportunity for you to help them fill out their memos and then ultimately make a case for you to their higher ups. The next up is corporate investors or strategic investors. These are established businesses who invest into startups. They'll either invest off the balance sheet or in a separate fund. A good example of this is I ran a corporate VC for a company called the Research Frontiers. And we were in the smart glass space, still are in the smart glass space. But we're in the smart glass space. That's glass that switches tints from clear to dark. And it's incredibly cool, very exciting technology. It's in all sorts of cars, planes, trucks, things that you've probably even seen around already. What we were trying to do is enter into the home, the architectural market. We were a team of chemists. What we didn't have was a smart home controller. So instead of spending a ton of money hiring people, training people to then tinker with different electrical engineering methods to create a smart home controller for our technology, we invested in a smart home controller, a universal smart home controller. And then through that investment, we then integrated our technology with their platform so that we could then accelerate our own time to market and go into homes even faster. We didn't have to spend all this time building a remote anymore. We didn't have to spend a ton of money hiring people. We saved a bunch of money because we were investing in this startup, because these 8 people out of San Francisco happened to figure out how to do this in a way that we hadn't yet. We invested, saved a ton of time, increased improved our time to market, and then ultimately even got equity in the company. And so it was a win-win for us. It was a win-win for the company because not only did they get capital, but they also got a strategic partner, a publicly traded technology company that they were able to use to expand what they were doing. And it accelerated both of our go-to-market strategies. So as you can see, this has a lot less to do with the fundamentals of the company and much more to do with how the company serves your interest as the corporate VC. And so when you're making a case to these corporate or strategic investors, you want to make a case more for how your companies can work together. Another excellent example of that is ChatGPT. OpenAI received a strategic investment from Microsoft. And next thing you know, you're seeing ChatGPT inside of Bing. You're seeing ChatGPT inside of almost every single one of in every single one of Microsoft's new products. That is the kind of deep relationship that these companies try to build with the businesses that they invest in. I haven't seen the deck that OpenAI gave to Microsoft. I have a feeling it had a lot less to do with the size of the AI market and a lot more to do with how OpenAI and Microsoft could work together. And then the last is accelerator programs. Accelerator programs are organizations who help small startups grow in exchange for equity. They'll typically invest around $100,000 into your business in exchange for about 6% of your business. In some cases, it's 4, in some cases, it's 8, but let's average that out around 6% of your business. They serve accelerator sponsors. So a good example of this would be, let's say you're General Motors. General Motors is interested in self-driving car technology. Rather than building their own self-driving car unit, they may be more interested in sponsoring an accelerator and saying to this accelerator, go find 12 self-driving car companies around the country. Incubate those companies, help them grow, help them get their stuff together. And then at the end of your relationship with them, here's a little bit of capital too. At the end of your time with them, we want to meet them. We want to meet them for what's called demo day. This is a big day, a big presentation. I'm sure you've seen this on TV. I'm sure you've seen this before in the past. It's the startup standing in front of the big screen behind them while they're talking to a network of investors, press, corporate partners, etc. They'll give a short presentation on their business. And then from there, everyone in the room will find time to meet with them after. So accelerators do all of this, again, in part for their corporate sponsors or for their funds that may be doing it for the same reason. As a result, when you're working on this one, this is going to be much more focused around why your product is specific. It is competitively, is more competitively positioned than others, and why your product is more unique than others. They are much more interested in innovation than they are in copying existing business models. And because, again, they're going to be taking this to the kind of people who may be running strategic investments. So in this scenario, you don't have to show all of your traction and all the other things. What they're much more interested in is early signal that at least customers want your product. And 2, much more information about your intellectual property, about the product that you're building, about the market that you're pursuing, etc. And so for accelerators, your deck will be lighter. And then on your demo day, your deck is going to be incredibly light. There'll be just a couple words on a page while you're speaking and telling the story of your business. And so with that, we covered a lot today. We went through 4 different types of investors. We went through angel investors, corporate/strategic investors, venture capital firms, and accelerator programs. Each one of them makes investment decisions differently. Each one requires different investor materials. And doing that right will let you put your best foot forward and increase your likelihood of being able to raise money from investors. With that said, thank you guys for taking some time. And now why don't we jump into some Q&A.
Thanks, Rob. I know there's a question there from Fiona. If others want to just raise a hand or throw it in the chat, that'd be great. Let's see. Are you seeing the chat, Rob?
Let me see here. Cool. So I'm seeing.
Maybe scroll to the bottom and see if Fiona's there.
Yeah, let me stop sharing my screen as well.
So Fiona just asked, how established are most startups before pursuing external funding?
That's a great question, Fiona. So you probably heard the stories of like some VC funds saying Uber's first office was our conference room. They love to talk about how early and how early and how early they like to be involved. That is extremely, extremely rare. That Summit is a different case. Summit also likes to get involved and be the first check-in. That is incredible. You guys are doing the work of helping build these companies from scratch. A lot of institutional or venture capital firms themselves may not be as interested in a brand new company. And so when you're just raising money for the first time, you're much more likely to want to reach out to angel investors or accelerator programs. In terms of when the right time is, that is a great question. When I raised money for my first company, we didn't have a product yet or a single customer yet. I had a mock-up on an iPad that I was able to show people, and my valuation reflected it. I had the lowest valuation then as compared to, what could have been a much larger business. That is a negotiation with the investors that you're getting involved with. Typically, the best time to raise money is going to be when you have a clear understanding of why you need that money. And that money is going to make a material difference in getting you to market or accelerating your growth inside that market. So what that can mean is either I already know who my customer is. I've been running this business for 1 to 3 years. I know who my customer is. I've built something that they like. I know exactly where to find my next customer. Now I need capital to go expand and go lead the market. That's one side of it. Another is I know the product that I want to build, but building that will require getting lab space, getting expensive equipment. But if someone is willing to make that bet with me and allow me to go buy those things, we could go make a material change in, let's say, the medical device industry, where something like that is very popular. Similarly, in something like medical devices, there is many tests and FDA approvals and things like that you need before you could even sell your product to a single customer. And so those investors who invest into biotech medical devices have like a very clear understanding of what their own milestones would be. Did you guys finish phase 1 clinical trials yet? Did you guys already file your IP? You name it. They will make their investment decisions based on that. Whereas a consumer tech investor may be interested in, do you guys already have a following online? Do you have an online audience? Do you guys have customers, sales? So I know it's a very roundabout way of saying there's no exact right time to raise money, but there's no wrong time either. Every single investor, especially angel investors, accelerators, will be interested at different phases and have different questions for you. But the best time to raise is when you have a plan. So why don't we, thank you, Fiona. And then, so why don't we go into the next one? I may not be reading these in order. So if someone else is reading these in a better order, otherwise I could just pick random ones from the chat.
Random's fine.
Okay, cool. So first of all, Chad, thank you for saying that you're digging Deco already. That makes me very happy to hear. And speaking of which, Chad has a question here. Do you start a deck with some must-haves and then customize, or are you always starting from scratch? And do you have a take on including things in your deck that are sometimes controversial, like financials? So let me answer the first one first. There are the slides that almost every deck includes. Those are things like market size, traction, product, how it works, etc., etc. Those are good. There is nothing that says that you have to include those. The first thing and the best exercise we do when we're building decks for our companies, and now we've done this for over 180 different ones, is we say, what are the reasons that I wouldn't invest in this business? I put on my investor hat and I say, what are the things that I'm worried about? I've seen an online social platform before. So my first question is going to be, how is this different than Facebook or TikTok, who are massive businesses that are highly competitive? So now you know that the first thing you have to do in this deck is make a case for why you're attracting a fundamentally different audience than Facebook or TikTok might be attracting. Similarly, your customers might not even have a problem in that scenario. What was the problem that Twitter was solving? No one could really answer that. Instead, that Facebook was solving. Instead, what did they do? They used their numbers and their traction to tell a story about this viral platform that the entire country was falling in love with. And that became the case for investing in the social business. And so what I'm getting at is put yourself into the investor's head as much as possible. and try to understand why they may not be interested in your business. Tackle those first so that now they know that you have thought through the holes in the business and have already solved for them and you've de-risked the business. So happy to go through that in more detail at a separate time. There's a massive art to exactly which slides you include in a pitch deck and when into who. But the best advice I can give you for now is try to put yourself in the investor's shoes and say, if I saw this business for the first time, what would be the 3 things I'm most worried about? Answer those first, because then from there, they'll be fascinated with your business. Next up was, do you have a take on including things in your deck that are sometimes controversial, like financials? In this case, it does depend on the context by which an investor is viewing your deck. So there's, we could do a whole separate conversation about the different contexts of your deck. There's the teaser deck, the leave behind deck, the public presentation deck, and a ton more. But when you're first garnering investor interest, let's call that your teaser deck. This is the deck that goes before you have an established relationship with the company. They have no loyalties to you. They haven't signed any NDAs or anything like that. They haven't dived into your data room. You could provide some information on, say, your attraction, your product, etc., but don't provide any information in that case that you wouldn't want your competitor seeing. I'm sure you guys have seen deals on AngelList, on WeFunder, on all these online platforms. Similarly, when you're sending a deal to an investor over email that you've just pitched for the first time and who doesn't know you, if your product looks competitive with one of their portfolio companies, they're going to send that to one of their portfolio companies and say, hey, is this competitive? Is this something that what's your take on this? So when you're creating your teaser deck, do not put anything in there that you don't want the whole world to see. Then there's your leave behind deck. By now you have a relationship of trust with the investor. If you don't, then don't send them this. But your leave behind deck is the deck that they'll use to create their investment memos. This is what we mentioned before with VC funds, or angel investors will use this to make a final investment decision, you name it. That one, give it all to them. Dive in on the financials, dive in on your unit economics, dive in on your intellectual property, and back all that up with your data room. Your data room is a big Dropbox or a big Google Drive or a big Ignite, whatever you want, whatever platform you want to use that will have everything about your business. Every contract with the customer, every piece of marketing materials that you've pushed out, your corporate bylaws, your shareholders agreement, you name it, your cap table, all of that will be in there, your financials. So when you're creating your pitch deck, you could link directly into your data room. We do this all the time, where if we're creating the financials page, we'll say, click to access full financial model. And then that will take them into a Dropbox that then has their full financial model. So my take on the controversial slides is think about what information you want the world to know versus what information you want only very serious investors to know, and then include it from there. I see another question here about, do you see startups focusing too much in product and not enough in sales, especially STEM-driven people? I personally think revenue and momentum should be of more importance when getting interest from investors. So that's a great question, because this goes into the different types of companies and the different kinds of ways that investors make decisions. There's some products where you just can't talk about customers yet. There's, again, go back to like medical devices. They have years before they will ever be able to reach customers. So their traction is defined differently than, say, a consumer product. In their case, like I mentioned before, they may be looking at intellectual property, phase 1 clinical trials, et cetera, path to FDA approval. And investors in that space will know what those milestones look like and will invest based on those milestones. For other people, I think what you saw years ago was this big emphasis on product and not enough emphasis on customers and revenue. In the businesses that I invest in, I am very attracted to revenue. I believe that if you're building a consumer product or you're building a SaaS platform or something like that, the best proof that your product is going to work is going to be your customers. So if you have it, flaunt it. If you have customers, use those customers to tell a story. I want to see on slide 1 the fact that you're generating revenue. Because if I'm looking at 20, 30 decks a day, which is, my inbox gets flooded with decks, the ones that I'm going to look at are going to be the ones that from the beginning show me that they have revenue. We led the Series B for this one company that was in the corporate catering space. I was not interested in the corporate catering space at all until I met this company, because on slide 1 of their deck, they said, XYZ company, a story of $0 to $18 million in revenue in 24 months. I was like, how'd they do that? I am intrigued. And so then from there, I fell in love with the business and we ended up leading their Series B. So they really turned us around by telling a story around their revenue. In other cases, I found revolutionary products that we loved. And we knew that this was going to be years before this thing would ever reach customers. So in those cases, we worked with them to say, what is your path to market, and established our own valuation on the company based on that. So again, very varied. But if you have revenue, if you have customers, use it. Oh my God, tell the world about it, scream it from the rooftops, because that is going to be the first thing that separates you from other pre-seed or seed stage companies that might be raising money.
Yeah, Robert, I see a lot like about the product being done, some marketing, but a lot of the sales is not a biggest focus, and it's or they're not necessarily out driven type personality. And I just think investors are looking for vision, the charisma. They're looking for, is there a path to someone actually buying this? Or are you thinking that they're going to buy this? It's proofs in the pudding. So that's why I asked that question, because you got to get something on the books, not just I am building a great MVP right now.
Exactly. That's the you know, in my company, for example, with Deco, the first thing I did is I got in front of customers and I just said, what do you guys want to see? Rather than trying to imagine what customers wanted to see, I spoke to customers and built for them, and then had revenue and used that revenue to tell a story around the kind of business that I'm trying to build now. And you know, our platform at Deco here, connecting startups with active VCs, that's not how Deco started. Deco started as a company that wanted to make money making pitch decks for companies. So we talked to companies and they hired us for different things. And as they hired us for different things and we were getting in front of customers and selling to customers, we arrived at the platform that we have today, which, you know, I can't claim credit for our vision, because our vision came from our customers who said, this is what we want to see. And it was proven by the fact that they paid us money for it. That is like the best case possible that you can make for your business when you're raising money from investors, because investors want to know that this thing is going to work, that this thing is going to, you know, get revenue from customers. And so if you already have customers and you're showing, hey, I've been speaking to customers have been paying me for this thing for years, you're going to stand out.
There's that self-serve model where they're trying to sell and do a repeatable and scalable, but if they actually start using their own product and do a service model, they'll actually understand what the client's going to feel and the problems, and they can fine tune it way before it gets too far and then you have to rebuild. So you want to turn that SaaS into a service as a service before you go software as a service, to make sure it's built the right way, because you're the one using it, because you're servicing the clients before it becomes kind of self-operated.
Exactly. If you could always build products in a vacuum, but it's not going to serve you. It's going to serve you as getting in front of customers, seeing what they want to see, and then using your tech to automate those things as much as possible after you've already shown that you know what the process looks like. You know, the best SaaS products start off as just services in the beginning that expand into software as a service. Can
you put your email address in here so we can chat? Because I don't want to take up everybody's time, but I want to talk to you further.
This is perfect, Michael and Rob. I mean, Rob, thanks for presenting today. It's great conversation at the end here at the Q&A. Yeah, if you can so you've got that in the chat now if people want to connect with you. Are there other ways they can connect with you or follow you and see what you're talking about?
Absolutely, guys. So yeah, the best, thank you guys again all for coming today. Seriously. You know, there's a lot of different ways you could spend your lunch hour. So thank you guys on that side. The best ways to reach me are either by my email, which I just dropped in the chat, which is robert@getdeco.com. Another way is you could just go to getdeco.com, fill out the intake form on our website. Little secret that goes directly to my inbox. That's another one. And by the way, if you're ever reaching out to a startup, I'm sure you guys already know this, just reach out to info@company. That's probably hitting the CEO's email anyways. But yeah, so you could either email me there, go to our website. If you're coming from Midday Connect, you also do get a discount on our services. And so just mention that you came from Midday Connect and we'll apply that discount as well. If I don't recognize their names already from this call. And yeah, and then you could look me up on Twitter. I make some terrible jokes there. And of course on LinkedIn. But best ways to reach me directly are via my email or through our website.
Thanks, Rob. Awesome. Thanks everyone for coming out. We'll see you next week.
Thank you, everybody.